Are we live? We're live. Amazing. Let me just make sure that I can go also live. Oh, perfect. Okay. Technology. I am definitely
we love
exploring. So, John, thank you so much for joining me. This is quite fun because I'm improvising all these new things that I'm learning. And thank you for learning with me. So, John, John, you are with a new company, or I found out recently, right, that you are now with New American Funding.
Yes.
And I would love to learn more and share with my friends, clients, fellow agents what your new company offers. And I know there's 100 programs you mentioned, so quite a few things I'm sure to talk about. So whichever you want to highlight, I want to kind of give people a sense of spectrum of what they can be finding.
Yeah, absolutely. Thank you for having me on. This is great, Karina. So what I want to talk about is pretty much what's happening in the current market as for buyers. Mm-hmm. They're getting frustrated. They're not getting their offers accepted. And this is something that's been going on even when the rates were real low. So it's not like no one can blame the interest rates. It's a supply issue. So the question is, how do you make your offer stronger? One of the things that we offer is we'll fully underwrite the borrower without a property. So when it comes out of underwriting, the only condition left basically would be get an accepted offer. So that's as close to being a cash buyer as possible. Another program that we just rolled out, which is great. It's actually our cash program, and how that works. This could be for first-time home buyers, and it could be for someone that wants to sell their house, but they're in a situation where they can't sell their house till they know they get an accepted offer on a house, but the seller won't accept their offer, or most likely won't if there's a contingency that they have to sell their house. So what we have a program is we'll underwrite the file. We won't have to debt them for the house that they're selling. And when it gets approved, the bank itself we have a program called New American Funding Cash, where we'll present the offer as a cash buyer. We will provide the funds. So New American Funding will actually buy the property on behalf of the borrower. So we send the offer, we'll say it's a cash offer, we'll show the proof of funds, and then the seller, assuming they accept it. And then at that moment, when the house closes, New American Fund owns the house and then sells it right back to the client, within a week or two of closing. So someone could actually be a VA, veteran doing 100% financing, or someone else doing maybe 5% financing. The seller doesn't even know that. We will already approve it. As far as the seller is concerned, it's cash buyer. And because we've already fully underwritten it, we're confident that we can get them a loan right after closing. So literally you could have a VA borrower making a cash offer.
John, can you just kind of walk me through it? So let's just say, for example, a property just came on the market. It's Monday. We are going to be making an offer, let's say sometime by Monday at 2 p.m., right? There's usually a deadline, for example. So how much lead time do you actually need, right, to do the underwriting up front?
Yeah, so how it works is I need the person to get pre-approved first. That's the ideal thing. Otherwise, everybody's scrambling and all emotions start, rising real fast. You don't want to do that. What will happen is two things happen. The underwriter will fully underwrite the borrower. The realtor needs to go through a 1 hour Zoom call to understand the program. What happens then is when you're going to make a cash offer, we have a transaction coordinator that will hold your hand literally and tell you exactly how to make the offer as a cash. They will send you over the proof of funds. So when you make that offer, you're making a bona fide cash offer for the borrower. And I mean, that is so powerful. So how that works, the details, like what does it really cost? Well, there's a 2% transaction fee that the borrower doesn't come up with, but when it gets sold back to the borrower, they're just adding the 2% to the sale of the new property. So let's round numbers. Let's say it's a $500,000 purchase. It closes. The 2% gets added to that. So now the loan amount will be based on the value of 510. So some might say, well, Jesus, 2%, that's a lot of money. Well, if you look at the big picture, that let's say they accepted that offer, cash buyer at 520. They may have turned down an offer at 5.25 with contingencies. So one might say the only way to get that house is you would have had to offer 525 or 530, where in a sense you really paid 510, so you still saved 10,000, maybe 15,000. So it's kind of like you got to look at what it's doing for you. What's the biggest thing it's doing for you? You're getting the offer accepted. You get the house that you've been looking, maybe 20 houses, you weren't getting offers accepted. This put you over the top. And you think about 2%. Let's just say it's all even 2%. I mean, what's the appreciation rate of houses these years around here? So like 2, 3, maybe even 4%. After 1 year, you're going to more than make up for that. The value, especially the fact that you're not coming up with the money per se. It's just being added to the price, and then the loan will be based on the price, the new price of the house. I mean, it's no different than, let's say someone's going for an FHA mortgage. Well, you still have to finance in that upfront mortgage insurance premium, which is almost 2% anyways. So the idea is, I always say, focus on what it's doing for you. What is it doing for you? It's getting the house so you can move in and start creating incredible memories for you and your family. That's what it's doing for you.
So it makes me think that it's sort of almost like a hybrid between somebody getting out and getting a hard money loan, right? Which usually is at a higher percent to begin with, right? And paying points. Do you know what I mean? So like if you look at it from purely like mechanical standpoint, this is sort of like an in-between where, yes, there's a couple of points that you're paying, but the points are also kind of going along with a more normal interest rate in the for the conventional.
Right. They're getting a regular mortgage program, so it's not like we're putting them into a special loan where it's a much higher interest rate.
Right.
It's a regular program, as though they were just got their offer accepted. If it's the first time home buyer and we have those first time, the home ready, home possible program, they can do that program as well.
Perfect. So you share with me, there's let me see if I can just share it actually, so everybody can just read for themselves. And forgive my technical difficulties in case I let's see. No. The browser has blocked your screen. I don't know what that means. Okay, let's see. Present, slides, share screen. Browser.
What caught your eye on that?
Oh, entire screen. Okay, maybe that should work.
You want to name 100 programs?
Yeah.
Oh, there we go. All right.
Am I sharing something?
No, I see. I see. I think I see your screen.
Can you see my email?
Not yet. No, we're frozen. I see us live, and then I also see us our image just frozen as well.
Oh, gotcha. Okay,
I see your mouth moving. So
you know what? Forget it. Well, I'll have to practice. Okay, so basically, you sent me a list of 15 programs: pre-underwrite prospects, bridge financing alternative, buy new home now, current residence later. Like this, is what you talked about, right?
Yep.
Non-warrantable condos. So that may arise when there's one owner that owns more than 10% of the units, right? It's in a building, right? What other situations might result in non-warrantable condo status?
You could have, it could be one of those situations where it's maybe over 30% commercial space,
right,
in the building itself.
Mm-hmm.
It could be a new development, and we could be the first one to lend on the property, opposed to waiting for the 50% pre-sale requirement.
Right. Okay.
You know what's a big thing now? It's been coming up more and more. Is it has to do with the insurance on master insurance, the deductibles. What's happening is a lot of the associations, to keep the condo fees down, they're looking at the insurance policy and they're increasing the deductible. Well, Fannie Mae has this, and Freddie Mac, they have this policy rule that the deductible can only be so high. Otherwise, all of a sudden, it will no longer be warrantable. And so if you ever get into the situation like that, I had one like that where the management company said, well, we're not going to lower the deductible. Well, we looked into the bylaws, and the bylaws said, we will always make sure that we comply with Fannie Mae guidelines. And we showed that to them, and we said, you got to change your insurance. And we were able to get it through just by something simple like that. So because sometimes it's a matter of looking at the bylaws in the condo association to see that verbiage. You know, especially if it's in there, it says we'll do whatever, we'll always comply with Fannie Mae, Freddie Mac, and then that puts them, you know, on the hook to, hey, according to your bylaws, you need to do this, this, and this. And
But, you know, I've noticed just recently there was a property in Lynn, which just happened to have a couple of incidents with some water situation, water damage, etc. And it sounds like they're still looking for their master insurance. And in some cases, like, I really wonder how long will it take them to actually find that insurance company, right? Because and to keep the deductibles under a certain level, because, you know, you have 2 incidents in 1 year. How many insurance agencies are going to be jumping over each other, right, to actually, you know, to sign you up at whatever the level of deductible that would be acceptable? It's interesting. Okay,
so go to, probably Lloyd's of London, right? They insure anything.
Oh, I don't know. Yeah, what is it called?
Lloyd's of London.
Good to know.
They insure all kinds of crazy things.
Good to know. There's a tip right there.
Yeah.
Okay, so then you mentioned construction/renovation programs, land loans, grant or down payment assistance programs. I'm assuming that's for first-time buyers, or is that not only for first-time buyers?
Yep.
Okay.
First-time home buyers, yeah.
What is so number 7? You have asset depletion programs. What is that, and how is that different from reverse mortgages, if that's similar?
Yeah, it's totally separate. So it's a way of getting qualifying income. So in other words, let's say after closing, someone happens to have, you know, in their account $500,000. We could take in terms of qualifying income, we could take the $500,000. They don't have to touch the money, but this is just how we qualify. We divide it by 240, and, you know, that comes out to a little over $2,000 a month. That $2,000 a month we can use for qualifying income. There have been cases where people had a lot more money, and just that formula alone, they were able to qualify for a mortgage. Where it comes in a lot is, let's say I need someone to have maybe a co-signer, like their parents or something. And a lot of times people will say, well, my parents don't make any money, they're retired. I said, well, you'd be surprised what we can use, you know, between pension, Social Security, and then this is where the asset depletion comes in, because, you know, the parents will have a nice sizable retirement account that when we use this formula, next thing you know, there was one case where the parents were just collecting Social Security, but in terms of qualifying income, just the parents alone, we had them at like $9,000 a month, just being able to use this, and they were able to coach them, you know, for their child to get approved for the house.
Oh yeah, that's really interesting. I don't think I've considered that. I have a client who's she's moving from Canada actually, and she was concerned because she's going to be selling property there, and she's not sure yet, you know, how much her salary in Massachusetts might be. So one of the questions that came up is, could she actually lean on her assets, right, as opposed to just the new income that she's going to be, right, whatever that is going to be. Right. So that's interesting. So she basically could use that formula, right, whatever the amount of money in the bank account.
Right. It's going to be very, very careful. It's going to be post-closing assets. So if they're going to use those assets for the down payment, that portion we cannot use.
Right. Got it. Net of happening. Got it. Makes sense. It's really interesting. Thank you. Okay. Then you have medical professional programs. I'm assuming it's people who freshly graduating, right, from that school. And
right. And there is, you know, as long as their student loans are deferred for at least 12 months, we don't have to debt them for the student loan. is how that one works. So it helps them qualify.
Okay, interesting.
Yep.
So they basically, so you're saying in some sense, people are better off buying fresh out of school, right, as opposed to waiting until maybe they start working because their student loans will kick in, right? And so you may have less when you. Okay.
Exactly. Yes.
Interesting. I'll let people know. Okay, reverse mortgages. I really, that's actually one of the reasons why I think I reached out to you last week about reverse mortgages, because I'm really wondering what options do people have? Like once, like say for example, kind of your average situation, let's say somebody's 75 years old. I mean, maybe they're gonna live until they're 120, right? We don't know. So what is the typical proposition from a lender, right? What is it? Is it, let's say, a 20-year mortgage? Is it a 30-year mortgage, right? Does it vary depending on when people, where people are age-wise, right? So can you just kind of give us a general idea?
Yeah, so it really depends on the age of the youngest person that's on the deed in the house. So typically, if someone's 62 years old, they'll lend probably around like 32% of the appraised value. Whereas if someone's maybe like 82, that might get up to like 42%. As long as the house is their primary residence, the reverse mortgage, I'll just keep it simple. When you get a reverse mortgage, it's like a regular mortgage. The only difference is you don't have to make the mortgage payments, and the interest will just start accruing. So it's like a negative amortization. But as long as you live in the house, they'll never call the note. So yeah, you can live till 120 years old. And the typical mortgage, the FHA mortgage, the HECM, it's a non-recourse mortgage. And what that means is, let's say the person passes away or moves out and the house has to get sold, and for some reason, let's say the mortgage balance is $700,000, but the value of the house is $600,000. That $100,000 is forgiven when they sell the house, non-recourse, which is it's a nice feature. And it's great too in terms of getting supplemental income. Again, you don't have to make a mortgage payment. Some people, the most popular product is like the line of credit feature, where people will set themselves up. Let's say it's a $300,000 line of credit. If you don't touch that, every year that $300,000 will increase. The available credit will increase by like 8% each year. So the following year, the line of credit will go up to say $308,000, so on and so forth. So even if you did take out a smaller mortgage and not make the payment, even though the balance of that is starting to increase, your available credit might actually increase as well, because it's it all depends on the size of the mortgage. The only thing you have to pay for, and this is true whether you have a mortgage or not, that is your homeowner's insurance and your real estate taxes. I know we were talking about, sometimes some people, they're not paying their mortgage, their real estate taxes, and the town might foreclose on them. In a case like that, if we found out they weren't paying their taxes, the reverse mortgage, what they would do is they would take a look at their age. Let's say someone was around 80 years old, and look at the actuary tables. They say, he's going to live maybe 10 more years. So they would actually escrow 10 years of real estate taxes. So if someone was normally going to get $300,000 from the reverse mortgage, and let's say 10 years worth of taxes to $100,000, they would put $100,000 in an escrow account. It's the borrower's money, but they would just make sure it's in that account to pay the real estate taxes. And then they would have the $200,000 to do whatever they want. If they pass away within the 10 years, whatever in the escrow account would just go towards the years when everything gets paid off. So it's not like the lender's not going to keep the money that's in the escrow account. It's just do that just so, because the person didn't demonstrate that they were able to make the real estate taxes, and the reverse mortgage company, they don't want the house getting foreclosed because taxes aren't being paid. So they do that. It's a nice safeguard is what they'll put in place for that.
Interesting. And so, I mean, I'll throw like a tricky question at you. Let's just say somebody is actually fairly comfortable. I mean, let's just say that they decided to use reverse mortgage more as a line of credit, like you said, right? So they do
Yeah.
have income. And so this is just a little extra something to tap into if they want to. But let's just say they decided to buy an investment property, right?
Yeah.
Maybe it's some really interesting opportunity. So could they do that and use the line of credit just like they would use HELOC, for example?
They can do whatever they want with the money.
Okay. Interesting.
You know? Yeah, another strategy, some of the financial planners, what they suggest is put in the line of credit. So let's say people are drawing against their investments. But let's say 1 year we have a down market. Like a financial planner will say, don't touch your investments. In a down market, touch the reverse mortgage, let your investments recoup. Because when you take money out after you lost, you're in a down market. If you take it out, it's less chances of being able to recoup if it's not there. So it's a strategy of tapping into the reverse mortgage line of credit during a down market of your investments, and then when the market's coming back, you can start tapping into your investments. It's a nice strategy of distribution of your wealth.
Interesting. And so another little quick trick question, I guess, if it is a trick question. So let's just say this person happens to live in a very, trending up neighborhood. So let's just say at some point they realize that their house is now worth, I don't know, let's say they started the reverse mortgage, let's say at 60 or 62, and then let's say 10 years go by and prices, I mean, not double maybe, but they increase significantly. So if that person actually wanted to sell the house and pay off the reverse mortgage, is that possible? Or is there some sort of restriction on what they can do once they sign up for reverse mortgage?
Well, if they sell the house, they have to pay off the reverse mortgage.
Right. No, but so they can't. They're not restricted. They could sell the house.
Oh, absolutely. In fact, they can purchase another house with a reverse mortgage as well.
Interesting.
Yeah. Because you might get into a situation where someone wants to downsize and they might still need a $200,000 mortgage, but they might say, and they might be putting $400,000 down, $600,000 property. But they're like, well, I don't have much income. I'm not even going to be able to afford the payments on a $200,000 mortgage. Well, get a reverse mortgage as the purchase. So you get the $200,000 mortgage, that being a reverse mortgage, and you don't have to make your mortgage payments.
Interesting. But you would have to put something down, right?
Yes, because again, it would be based on their age, and then the percent. It would determine the percent of how much you would have to put down. So, if they were like in their 70s, most likely they'd have to put probably like 60% down. But
60? 60?
60, yeah, for the reverse mortgage.
Okay.
But, that same person may have thought they were going to be a cash buyer, but then they realized, the house that I'm looking at, I'm going to need another $200,000 in my search. But I only get the $600,000. What am I going to do? How am I going to do that? Well, the reverse mortgage will solve that problem.
Interesting. Okay.
Yeah.
Yeah. So I won't throw any more questions on the reverse mortgages, but I think it's an interesting topic for a lot of people right now, especially like you said, or like we were talking last week, because I think taxes are just creeping up and up and up, and I think a lot of people are getting concerned, and just even the idea of like getting into something new, I think scares people. So I think it's really just valuable to understand all these options and have a detailed, like a kind of quality conversation about it, rather than, I think a lot of times people just kind of scan through some materials, they get something in the mail and they say, I don't know. Right. So I think it's really.
Yeah. And speaking of taxes, like any distribution you get from a reverse mortgage, you don't pay taxes on it. So you don't claim it towards your income or anything.
Oh, I see.
Yeah. You're just drawing the equity out of your house is what you're doing.
Gotcha. Makes sense.
Yeah.
Okay. And then you mentioned, so borrowers with only ITIN, so no social security number, is that somebody who's maybe like not, like maybe they're going through process of immigration, but they're not quite there yet? Is that?
Yeah, exactly. Yeah. Yeah. Because there's a lot of borrowers out there that use their ITIN number on their tax returns. You just show if they have credit, you're able to establish credit. So typically, if you have 2 years worth of credit, 2 years of tax returns, we can use that.
Mm-hmm.
That as well.
Okay.
Yep.
And then number 11, you have being
So,
stable.
I-10 is individual tax ID number, in case.
Right.
Yeah.
Yes. Thank you. So next one, you have bank statement program.
Yep.
Is that basically asset-based borrowing versus income, or is it?
It's deposit based. They look at the deposits, they average it out, and then they have a factor that they assume. It's really designed for self-employed borrowers or someone that's a 1099 that really hasn't been able to document it on their tax return, so they'll just go off of the bank statements to determine the qualifying income.
So, but it applies to both people who are buying as homeowners and investors, or is it just for homeowners?
Both.
I mean, for occupants. Okay, both.
Yep.
Got it. Okay. You have a program for foreign nationals,
Mm-hmm.
which is pretty self-explanatory, I guess. So those are people who don't have ITIN, or they would need to have one also.
No, those are like a true foreign national, someone that they don't file taxes here.
And so what does that look like? Is it like a extra high down payment, I'm assuming?
Yeah, it's like about 35% down payment.
Okay, and the interest rate, I'm assuming it would be a little higher, obviously, than normal.
It would, yes.
Okay. What is number 13, cross collateralization?
Yeah. So sometimes some people, they might want to buy like an investment property and they might not have enough money for a down payment, but they own another property as well. So they'll just put a lien on both properties and figure out the value for both, and that's what will determine the equity position.
But does the second property need to be income generating?
No. No.
Okay.
No, they'll just use that to protect, because they're going to be putting a lien on both properties.
Got it.
So that's good and bad. So the bad part would be if they wanted to sell one of the properties, they need to have enough proceeds to pay off, the mortgage, because most of the time they won't allow a partial release. So
got it.
So you got to be careful on it.
Yeah, and so you have DSCR, debt service credit ratio, and then you say many more. And many more is what is it? 85 more, right? Because you said you have access to over 100 programs in these 15. Yeah, or 14, I should say. Yeah. So DSCR, if you don't mind, just briefly describe what that is. Debt service.
Yes. Yeah. So that's basically it's an investment property, and it's more that the property needs to carry itself. So in other words, if you get the rents of, let's say rents of $10,000 a month that you're receiving, and the total mortgage payment is $10,000 a month, then that passes that test. They typically want to see one to one. That property will carry itself.
So you're not looking for like a 1.15 or 1.2 ratio for? No,
well, it's all different. There's 1.2 and go as low as 0.75, and that will just determine the lower the number, right? Because that's more riskier. They'll probably want more of a down payment.
Okay.
So if you're at like 1.1, they're going to want maybe 15% to 20% down payment. If you're below that, where you're a little underwater, they're going to want 35, maybe 40% down payment.
I got you. Makes sense.
Mm-hmm.
Okay, so we were planning to talk for 15 to 20 minutes, but as always, of course, the conversation just flows, and it's so. But thank you. This is really great information and great pointers. I feel like there's not enough detail. I feel like there's a lot of short content, short form content, which I appreciate. Yep. But at the same time, it always leaves you hanging. It's like give me a little more information. So I will share. So I don't know if you want to share with me any preferred way to contact you. I do have your email address and also your website, newamericanfunding.com/mortgage loans/John Marroni. So I can include that.
You can also find me on Google, John Marroni, Marroni. You Google me, you'll see a bunch of material and videos and what have you. Even my reviews.
Terrific. I mean, I suggest you also hop on Instagram, just because I feel like there's so many people you're just getting a lot of short little bits, so I
Yep.
feel like if you just post, I mean, ideally, I think honestly, I think ideally we need to all talk, like actually do video, which I have been hesitating for the longest time. But
Yeah.
truly, it's not a big deal, and it's in the sense that, I mean, it doesn't have to be quote unquote polished. I think it's just the essence of what are you trying to convey, and if it's something useful. So I feel like you, especially with the depth of your knowledge and experience, you could be educating, even if it's just one little thing, like a definition of something, or just one little anecdotal story about maybe how you've solved a problem, or maybe some transactional, like literally like real estate storytelling, I'm calling it. I feel like it would be so invaluable, and I feel like that would be the best way to build relationships too. Like, I mean, you have, I'm sure, plenty of relationships existing, but just in terms of like helping new people kind of
Yep.
get in, appreciating the whole spectrum of how many things.
I will definitely put that together. Definitely.
Yes, look forward to it. Please send me a link. Okay,
All right.
sounds good. Thank you so much for jumping on, and thank you for experimenting with me on StreamYard. We shall get better. But I'm sharing this on LinkedIn, YouTube, and allegedly Instagram. We'll find out if it actually worked out. But that was the idea.
This is awesome. Thank you.
Yeah, thanks so much. So nice to reconnect with you.
All right. Awesome. All right. We'll be in touch soon.